Welcome back, everyone. Michael here with Offshore Citizen. It is no secret that a lot of people over the last year in particular, but going back further, have been relocating to Portugal. And there's a bunch of reasons for this. They have the NHR regime, which helps to make things more tax efficient, as well as they've got some pretty good visa programs. Quality of life is pretty decent. There's a reasonable entrepreneurial community developing there. So these things make it fairly compelling. In fact, it's so popular that I just heard from somebody today that one of the banks there has stopped accepting new clients till the end of the year because they've got too many applications coming in. So that tells you a little bit, right? On top of that, you have various different funds that are becoming oversubscribed, and so you can't put money into them anymore and things like this. There's lots of demand. In the process of this, of course, as you go there, there's tax planning issues. And there seems to be some bad advice that has been circulating in certain areas, just kind of some careless little details. And so I've done some videos in the past on tax planning for people relocating to Portugal. I've talked about various different regimes, but I'm going to talk today about tax planning for people relocating to Portugal who are freelancers or self-employed people, and discuss kind of some of the pitfalls, some of the common things that people would get wrong or overlook, and then some of the things that you can maybe get away with and how things actually work. So we're going to cover that today. Before we do, if you haven't already, please hit the subscribe button, hit the all notifications. Really appreciate you subscribing. Thank you for your support of the channel. We're working hard to grow it. So if you like it, please share it with your friends. Want to do really well there. If you'd like help with the things that we deal with here, which are international tax optimization, asset protection, forming companies, opening bank accounts, if you want help getting residency, golden visas, etc. in places like Portugal, or if you'd like help getting passports, second citizenships, etc., citizenship by investment, citizenship by descent, etc., please reach out to me. You can book a call, calendly.com/Michael-Rosmer. There's a link in the description below. Or you can send a message to our websites, offshorecitizen.net and offshorecapitalist.com. All right. So let's start at the beginning. So imagine you go to Portugal. So most of the time, if you're going to relocate there, you're going to get the NHR regime. And even if you're doing something else, you're going to go for that. And the main reason for this is generally, if you don't have the NHR regime, with the possible exception of if you can fit into the simplified regime, taxes in Portugal are pretty terrible. They're really quite high, and the rules are bad, and it's difficult to get around them and things like this. Okay, so you definitely want to go for that regime. And I've done another video on it previously. The biggest thing about it for most people is you can get dividends tax-free. There's a variety of other benefits, but for our purposes in this conversation today, you can receive tax-free dividends, okay? So great. Now, aside from this, you're gonna probably, if it's just you and you're working locally, probably the simplified regime is the best way to go. If you're not, and if you have freelancers who work for you, contractors, etc., employees, then usually you're gonna wanna set up a foreign company. Okay. Now, that's great. It's perfectly fine, but this can immediately run into some pitfalls. Okay. So the first is if you set up a company in a low tax country, right? Whatever, pick one, and you're the one who's managing, controlling it from Portugal, then that's basically a Portuguese tax resident company. Now, in practice, I noticed that the Portuguese tax authorities don't seem to go very hard on people under the NHR. And that's probably for obvious reasons, that they're trying to attract people in. This being said, technically, this applies. And so what does this mean? This means that you can't be the sole director of that company. Okay, that's like right off the bat. And this enters into the first problem that some people kind of put out. And I've seen this advice given not just for Portugal, but for other countries as well. And that is they'll say, hey, just get a nominee director. Well, the reality is this is bad advice. A nominee director under review will not hold up, okay? Understand that very clearly. Nominee directors will not hold up to the standards of management and control. So it is not merely that I list some other name there. I can't just put 5 people's names down and say, oh, great, Courts are gonna go based on the principle of substance rather than on form, okay? And what does this mean? This means that whoever you appoint as a director needs to do real stuff, okay? So it is possible that if you have a nominee director, it will decrease the likelihood that they look at you because they may look at it and say, oh, look, he's not the director, or there's another director, etc. But from a tax standpoint, it will not accomplish really anything legally. If you're in a situation where that person who is the nominee director is there, it may hide your information, and so that may be useful from like a privacy standpoint, right? So there can be that use case for nominee directors. But from a tax standpoint, it doesn't achieve anything. So what do you do instead? Well, you can genuinely have a foreign company, and you can genuinely have it, but what you need to have is you need to have some sort of former directorship there, okay? And so the easiest way to do this is if you have people who already work for you, to engage them and put them as a director on the company and have them involved in the decision-making process. And the reason why I say that is because then it's not a sunk cost, right? In other words, you're already paying them to add real value, they're adding real value, and you engage them a little bit more in the company. Perfect. That's kind of the easiest. The second option is that you can go and you can get a director's service that will come and, you can basically hire licensed fiduciaries, or maybe not licensed fiduciaries, either way, but hire somebody to specifically provide that service for you. This is also perfectly viable, right? It's perfectly legal. The good news is these guys usually have some understanding of what it is that they need to do. You need to genuinely have them have some level of control, etc. They'll probably be involved in, facilitating certain of the decision making. The problem with it is it's typically a sunk cost, because whereas that employee who's working for you, they're really doing stuff, so it's worth it for what you're paying them. In this case, you weren't paying this person, now you added a cost. So it's a little bit less efficient. Possible, but a little bit less efficient. Okay, so those are the two things. Now, let's say we take care of that. What's next? The next thing is, conceivably, if you're in a small business, you're probably adding real economic value to that company. So you could constitute a permanent establishment for the company. There could be some things going on there, right? If that's the case, what are the consequences? What's going to go on there? Well, usually, depending on how involved you are, if your involvement is very minor, then it's probably not that big a deal. But if your involvement is significant, which for some people it is, right? They are the business and then they're just kind of supported by other staff, then you probably, if you want to make it viable, should segregate that, okay? So in other words, the way that it works is this. A company is liable for tax in a jurisdiction where there is source income to the extent that that contributes to the economic value of the company. Okay, let's use an example of this. Let's say that I have a company that makes, $1 million a year, right? $1 million. And if I was the only person, and I'm sitting in Portugal doing all the value, well then it's really clear that, that should be Portuguese source income, right? If I'm in a situation where, okay, we've got a bunch of people working for me, there's a bunch of people on the company, they're doing a bunch of things, etc., then you should only be taxable to the extent that you're adding that value. Now, this is kind of a difficult thing to figure out. It's open to ambiguity, etc. So the easiest way to solve this problem is to separate it. And you separate it by having some sort of a legal presence in Portugal, which you get paid for. So that foreign company would pay this, whether it's a company or a sole trader relationship, whatever that registration is, right? That is paid, and taxes are paid on that portion of the income there. And in that case, if the tax department ever asked, you would say, hey, no, the stuff that's in Portugal, we have, it's here, we do that, yes, we pay taxes on it, everything's good, all the rest is left abroad. And so you can kind of make that separation. Now, the good news is wages are pretty low in Portugal, so there's different ways that you can attribute that and make it pretty reasonable. Now, you do have to be aware that that could trigger some transfer pricing situation. If you're talking about related parties on either side, depending on how you structure it, what kind of the legal structure you have on either side is, it's something to be aware of, and so you have to follow those rules, but not too bad. The third part, the last part, is Portugal has controlled foreign companies rules, as does every EU country now because of the anti-tax avoidance directive. And so what this means is that under certain circumstances, they are going to require you to include the income, your share of the income of that foreign company, and pay tax on it at 35%, which is pretty high. So that's not so great. And how do they determine that? Well, they have a blacklist. There is an ownership threshold, and there's some other little tests. Okay, so the first most basic thing that you can do to get around that is that there's an exemption for EU countries. Okay, now this is next where we run into an issue. Some of the advice that I've seen given, which is not good advice, is that exemption applies only if there is real economic activity for that company outside of Portugal. Okay, so in other words, you can't just put a shell company out there and say, oh, it's a shell company, so it's in the EU, so it's fine. No, it doesn't work that way. If they were to review it, and again, most of the time you will not get reviewed. Okay, so I'm giving you the details of like, okay, if we want to follow the letter of the law and make sure that under review that we're going to withstand it, that's different than if we say, hey, I'm just going to go out and do whatever and count on not getting caught. If you're going to do that, well, you can do all sorts of things. But if they do catch you, different situation. So we're assuming that you want to do it properly. So in that situation, you're going to want to say, okay, you can use an EU company, and in, I would say, at least 50% of the cases when I'm working with clients, we use an EU company. It's not always the case because sometimes there are better options, but in a lot of cases, an EU company works perfectly well. In that situation, you need to make sure that that company does have real economic activity outside of Portugal, which typically, they look at premises, they look at assets, they look at employees, etc. So you need, typically people is like the biggest thing, okay? So that's important. And why this is important is because sometimes you might say, oh, hey, I want to have multiple companies. One of them, maybe I can show the activity, but another one I can't. That becomes an issue, okay, or a risk factor. So very, very important. So that's the thing for if you want the EU. Now, if you don't want the EU, then you have to stay, okay, as a company on a country that has a blacklist. So that becomes an issue. Almost every tax haven in the world is on Portugal's blacklist. It's super extensive. It's very if you want to know, hey, what are the tax havens in the world? Just pull up the list and go through, and you're pretty much going to identify them, and you can start doing some research. So that's a bit of an issue. In those cases, you kind of have to dig a little bit deeper, and so there's some other ways of looking at that. But most of the time, you'd want to stay away from a blacklist country if you were going to operate with a non-EU country. Now, the other thing is that even if they're not on the blacklist and the tax rate is less than 50% of what the tax rate in Portugal is, so 21%, you can do the math, then you're going to be liable for CFC rules again. So, you don't have to worry about it if you're in a country where the tax rate is higher than that amount. So anyway, I hope that helps, gives you some idea, some framework. I wanted to clarify because I've seen, like I said, somebody talks to someone who's not really a tax expert. They're more like selling company services or something like that. And as a result, they end up giving some little bit dangerous advice. And so you don't want to get caught into that. So I hope it helps. If you have questions, put them in the comments below. If you want help with it, please reach out to me. Follow me on Twitter at Michael Rosmer. And I'm going to look forward to seeing you guys on the next video.